All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcoming you here for a special Wednesdays with Stephany Pomboy. Hi, Steph. How you doing?
I'm good. How are you, Adam?
Well, I'm great, and particularly excited today because not only are we going to get to have you on your regular twice weekly or bi-weekly appearance on this channel, but we're joined today by a special guest. We're joined by pension expert Ted Siedle. Folks, you've heard Stephany and I mention many times in the past that our pension system definitely has some concerning vulnerabilities to it. I'll say that. That's probably a big understatement, as Ted will explain in just a moment. But Ted, who I've interviewed a couple of times over the years, great guy. He is a former SEC attorney, and his firm has pioneered over $1 trillion in forensic investigations into the money management industry. He's nationally recognized as an authority on pensions, and he's testified before the Senate Banking Committee regarding fund scandals and is an expert in various Madoff-related and other investigations. He also secured the largest SEC whistleblower award in history and the largest CFTC award in history as well. So, Ted, thanks for joining us today. I've got a lot of road to cover here. Folks, if we have time at the end, I'll try to take some questions from the audience as well, so you can ask them of Ted. I want to start just by reading something that you wrote a few years ago, Ted, and then we'll kind of open up this discussion. You said, quote, "We are on the precipice of the greatest retirement crisis in the history of the world." And that makes perfect sense because, first of all, we have the largest elderly population in the history of the world. Just focusing on the United States, our elderly are woefully unprepared to retire. And in the decades to come, we will witness millions of elderly Americans, baby boomers and others, slipping into poverty. Too frail to work, too poor to retire will become the new normal for many elderly Americans. All right, so that is the tough news. The question is, what do we do about it? But why don't we just start at the very top, Ted? I know we got a lot of specific questions we got to get into, and there's a number of specific investigations you're involved in right now across the country. But at a very high level, what is the state of our pension system, and why are you this concerned about it?
Well, of course, Adam, most people don't have pensions anymore. Pensions are phasing out, but for those who do, there's lots to worry about. I do a lot of my work with state and local pensions, which are called public pensions, as opposed to corporate pensions that are private pensions. And public pensions that have about $6 trillion in assets in them are not regulated on the federal level at all. Corporate pensions are regulated under ERISA, so there's a comprehensive federal law. Public pensions, state pensions, are not governed by any comprehensive law. The boards of these pensions consist of firefighters, policemen, politicians, none of whom have any investment experience. So they're watching over, making decisions about how to invest $6.5 trillion of state workers' money. So there are a lot of things to worry about in the public pension space in particular. And what we've seen over the last 20 years is allocation of ever greater assets to high risk, high cost, private equity, hedge funds. And now we're on the precipice of state pensions investing up to 10% in crypto, which has never happened in history. And that's what we're poised to happen now. I think 17 states have legislation to invest up to 10% of their assets in crypto.
That is absolutely frightening. So just to recap some of the previous discussions we've had, you really boil this down simply in a way that's easy to understand, where you say when it kind of comes to the solvency of pensions, it comes down to three things, and correct me if any of this is wrong. It's how much you put in, right? It's how it's managed while it's there, and then it's how much comes out, right? And I think you can kind of walk through each and tell kind of a scary story about each one of those steps. But my recollection is maybe the scariest story is not we're putting in too little and we're taking out too much, but it's how mismanaged it's being when it's actually in the pension system. Am I correct in this summary?
Absolutely, Adam. So the three elements are money in, which is called contributions. And then then the money sits in the pot for 30 years and it's managed. That's money managed. And then the final thing is money out, which is benefits paid. And so there's a lot of attention is paid to is enough money going into these state and other pension funds, are the pension benefits paid out too rich? There's a lot of attention paid on contributions and benefits, very little attention, almost no attention paid to how is the money actually being managed over time. And what you understand, particularly if you read this book, Who Stole My Pension, which I wrote with our friend Robert Kiyosaki. Over a 30-year period, if you're losing even 1% or 2% a year through excessive fees or mismanagement, over a 30-year period with compounding, you're losing half your money. And so it is the leakage, if you will, over the 30-year period through mismanagement that causes funds to have half as much money as they should at the end of a 30-year period.
Okay, and just some elements that kind of go into that mismanagement. First, you have, as you mentioned, perhaps a lack of expertise on behalf of the board that's managing the pension. Like you gave an example of firefighters or teachers who are sitting on the board there. They might be great at putting out fires, but they don't have an expert investing background, and yet they're making these big decisions. Secondly, you've said that in the past that Wall Street looks as pensions as kind of the dumb money. What does Wall Street love to do? It loves to sell dumb money products that it makes a really big fee on, right? And so you kind of went to the extreme on this with the example about crypto, but from our previous conversations, you've given lots of examples about how pensions get kind of influenced, or you might say swindled, into investing into all sorts of alternative investments. And this can be anything from private equity to stadiums to private credit to all sorts of other things. And we tend to think of pensions as, they have to be safely managed, and so they're probably mostly in safe bonds. You kind of blew my mind the last time we talked, saying like, no, there's a small minority in those type of investments. It's now mostly a lot of junk. Is this all true?
Absolutely. The craziest case I ever came on was in Ohio. The state Ohio Bureau of Workers' Compensation invested in Beanie Babies, and of course lost their money. That was one of the wildest schemes I've ever seen.
Wow.
But yeah, what Wall Street knows that public pensions are the dumbest investors in the room. Their boards consist of laymen that have no investment experience at all. And as I mentioned earlier, Wall Street knows that these public pensions are not regulated as comprehensively as ERISA. So they can sell crap to public pensions that would never fly in the corporate pension market. When you look at their contracts, you'll see that these investment contracts, they say this account is not governed by ERISA, which is sort of a way of saying anything goes. So yeah, you will see the oldest alternative investment in public funds or in pensions has been real estate. You'll see real estate, private equity, private credit, hedge funds, hedge fund of funds, hedge fund of fund of funds, which I've investigated in some cases. So you'll see some pretty wild stuff that is very unusual. And the last thing I'll mention about public pensions that makes them unique is they are supposed to be the most transparent of all pensions in the world, because every state has a Freedom of Information Act or public records laws. So theoretically, public money is supposed to be subject to public scrutiny and accountability. But what has happened over the last 25 years is Wall Street has eviscerated public records laws by building into contracts that these investments are quote unquote trade secrets, and don't have to be disclosed to the public.
Mhm.
All right. Well, look, folks, I just wanted to sort of set the table here. Ted, thank you. You've done a great job of getting us pretty far down the road in a pretty quick period of time with these great, specific but concise answers. Steph, I'm going to hand the baton to you here, because you know a lot more about the situation than I do, and I have also interviewed Ted several times in the past. So let me let you start driving here. I might chime in once or twice with a clarifying question, but take this conversation where you'd like to take it.
Thank you. Well, please chime in, Adam, for sure. But, obviously my main focus has been number 2 in the 1, 2, and 3, and that is the management side, and specifically this rush into alternative assets that's completely taken off post-COVID, especially with the advent of private credit now and all these new fangled alternatives. And I just saw disaster written all over it, with recollections of Michael Milken peddling junk bonds to the pension fund so successfully back in the 80s. And this seemed like the new iteration of that. But a couple of things I'd love to get your thoughts on, Ted, that kind of dial it back. I know you said that you believe this is setting up for the worst pension debacle, which is saying something since we've seen several pretty spectacular spills. And I would agree with you. But from a macro standpoint, I see it as a function of this mismatch between real world rates of return and the ridiculous return assumptions that a lot of these pensions have built in to their program. So as far as I recall, the numbers originally were, double-digit annual return expectations, and they've came down somewhat to around 7 or 8% was sort of the last number that I had. Is that still the case? Are these numbers still that insane that there are high single-digit assumed rates of return?
Yeah, Steph, I think the average is about 7%, 7.5%, somewhere in there. Still very high. And the funding levels of public pensions are, I think, average about 75%. So they have 75 cents for every dollar in benefits they promised. And that, by the way, to your point, Steph, that's assuming the values on hard to value, illiquid, opaque private equity and other private investments are true. And they're not, as you know. But these funds are, let's say, 75%. These pensions are 75% funded if you believe the valuations that are being offered.
Yeah, absolutely. And then, the mismatch that I see is that you are expecting 7%. And we went through basically a decade of artificially repressed interest rates where the real world risk-free rate was pretty close to 0, which forced all these pensions to go into the farthest corners of risk to get anything approximating a 7 or 8% return. So that's sort of the angle that I come at it from. And then I am looking forward to you just completely blowing my hair back on the nitty-gritty details of the obscene amount of risk that they're taking. I mean, I look at the only data I can find, broadly speaking, on the total pension system comes from the Federal Reserve's flow of funds accounts, and they give you the total amount of underfunding, and then they also have a proxy for other assets, investments in other assets, which I assume is a catch-all that includes a lot of these alternatives, and that alternative bucket has gone from 0 by their measure percent allocation pre-COVID to 13%, which I know is not the number. I mean, the total exposure to alternatives is probably closer to a third now or something like that. Do you have any sense as to broadly how much money is tied up in these super illiquid, highly speculative assets?
Yeah, I think the number I believe is somewhere around 35 to 40%. Yeah. And what I've seen in every public pension I've investigated, and I've investigated about $1 trillion, including the state of Minnesota, the state of North Carolina, the state of Rhode Island, and Ohio, state of Ohio. In every case, the allocation to alternatives is understated. They say they're 25. Most of these funds say they're 25 to 30, 35%, but the actual allocation is much greater. It's just how do you define alternatives? For example, is real estate included in the alternatives? But one of the most important things to remember about alternatives is that they have exponentially greater fees than traditional investment accounts. So you're looking at fees of at least 2% plus 20% of the gains. And there are additional fees that if you forensically investigate, the all-in fees of these funds can be as high as 7 to 10% annually.
Wow.
So when you talk about having an investment assumption that you're going to return 7% a year on alternatives, you have to make at least 10% a year to net 7% a year, which is just not going to happen. So that's one of the reasons I focus in my investigations on, are the fees being properly disclosed? And the answer universally is no, they're not. And one of the things I wrote about just I think it was just last Friday was I did an investigation of the $146 billion Minnesota state pension fund. And by the way, that's an example where the chairman of the board of the pension fund was a fellow named Tim Walz, who turned out to be the vice presidential candidate. Tim Walz acknowledged that he had never bought a stock or a bond in his life, yet he's responsible under law as the governor for $146 billion. But what I came out with last week, the state admitted that after my investigation, that they had underreported the alternative fees by 400%.
Wow.
And nobody in Minnesota has written about it. I asked in this column, this Substack I wrote, does it even matter if the fees are that wrong and no one in the state even reports on it?
Right.
Then maybe the funds shouldn't report any financial results at all, because they're so dramatically off.
Wow. It's like if a tree falls in the woods, I mean, but it explains why the pensions are the patsies, for Wall Street, because in addition to being able to unload all of these highly illiquid assets, they collect fees upon fees upon fees, continuation funds and all of this stuff. The other thing that I noticed had started to happen in this era of financial repression that was forcing them to, take on more risk, and they were getting into alternatives, was then you also had, like CalPERS actually adding leverage to the mix. Have you seen that more broadly, or was that sort of just exceptional among a handful of state and local pensions?
Well, every private investment I've ever reviewed, and I've reviewed thousands, every hedge fund, every private equity fund has built into their documents leverage. Right. And in fact, many of them say they can engage in unlimited leverage. So there is leverage built into every alternative, whether it's real estate, private equity, it's there. And so I've seen that, and it's not reported anywhere because, first and foremost, the pension officials, these cops, firefighters, school teachers, they don't scrutinize the documents. They don't understand what the documents say. And so it's not reflected in the financial statements either. And one last thing, recently, a couple of years ago, CalPERS went to sell a bunch of its private equity. And they said they sold the private equity at a 10% discount on average, 10% below the stated value. But there are two things to keep in mind. First of all, they probably almost certainly sold their most liquid private equity first, because that's what you do, and you hang on to the garbage you can't sell. And second of all, that was an effective rate of 10%. Some of the funds that they sold at that time were sold as much as 40% discount.
Wow. But, you know, I understand the leverage built into these various vehicles for sure. But weren't some of these state and local pension funds actually adding leverage on their own end, like borrowing money to put into alternative assets? Or was that not what was happening there? I thought CalPERS was actually adding leverage as part of their investment process.
Yes, that's my understanding too, and I think they were. That was publicly reported that they were going to be doing this. So it has not shown up in any of the investigations I've done so far, and CalPERS is one that I am currently being asked to investigate, but I haven't looked into that.
Yeah. No, I mean, it's just like lighting a match to this already blazing tinder. But I guess the other question, you know, going back to these illiquid assets and how they have to sell the most liquid parts first and hang on to all the garbage and hope eventually that the market provides them an opportunity to unload. There are also lockups for a lot of these investments. I assume, you know, they can't in a crisis say, all right, we want our money out. And you're seeing like the endowment funds now. I think Harvard the other day came and said to some private equity funds, you know, we're starting to take our money out of there. So the line to the exit is starting to form. And I assume that the state and local pension guys will be the very back of the line by the time they wake up and figure it out. But do you have any thoughts on that?
Yeah, that's absolutely true. Your observations are correct. I have seen private equity funds that have, your typical private equity fund has a 10-year life, but that life can be extended at the discretion of the general partner. And I've seen these funds extend and extend. They call it extend and pretend. But I have seen some that have a 50-year life, which I call cradle to grave funds, because you'll be dead before you get your money back. But that's a very real issue of can you get out of these funds? And every private, one of the hallmarks of private investments is that every investor in a private investment can essentially have a different deal, including different liquidation rights. So you have to negotiate that up front. And of course, the dumbest investors in the room are going to have to
negotiate. Right? Yeah, absolutely. So playing this out, I mean, obviously this is right now a slow motion train wreck. How do you see this devolving going forward?
Well, first, you're absolutely right. It's slow motion because none of these alternative investments are being
priced.
The performance they're not reporting on a current basis. So whatever you see it for a public pension, whatever you're seeing in their fiscal 2024 year-end statements, that was not the value at fiscal year end. So that's why we say you can extend and pretend that you can continue to carry to inflate the value of these investments long after they have fallen in value. And so they give institutional investors cover because they can say that they're outperforming the market or performing better because 25 to 40, 50% of their assets are not being currently valued. So what will happen over time is that they will continue to delay the day of reckoning as long as possible, and as usual, cut benefits and try to increase contributions, all to make the problem go away. The thing to remember about pension funds is that the politicians running state and local pension funds will be gone within 4 or 8 years. They will make decisions which they say will produce results within 30 years. No one will be there in 30 years. None of these elected officials will be there 30 years from now. And even if they were, no one would remember. No one has a timer that says, all right, your time's up, you got it wrong. So
Right.
it's like, if you were to ask me, Steph, could I, for $1 million, give you an opinion that your personal pension will be doing fine 80 years from now? I'd say, absolutely. I'll give you that opinion. Give you the $1 million.
Right.
Because I'm not going to be around 80 years from now.
Right.
And so one of the things I found, I've worked with the many corporate pension plans that have been taken over by the PBGC. And one of the things I say is there's never been a pension that failed that didn't have a room full of experts saying it wouldn't.
Oh my gosh. Because I envision 3 different things that could trigger sort of the acceleration of the pension crisis. One would be obviously just every day this demographic issue is insurmountable. So every day you've got more people taking money out than putting money in. So that becomes a problem at some point. The other one that I envision, and I'd love your thoughts on, is, for example, this Harvard pulling money out of private equity. That will at some point create a mark for some assets. Does that precipitate a repricing of those quote unquote assets across the board that then is reflected in the pension funding status that causes some kind of a wake up call there?
Well, one of the things that I emphasize in my work is to understand any of these investment issues, you have to be aware of pervasive industry conflicts of interest. So each of these pensions has a private or alternative investment consultant who advises them specifically on their private investment portfolio. Well, that advisor has a conflict because if I tell you now is the time to get out of alternative investments, you're going to fire me. You're not going to have any need for me. So there are these conflicts every step of the way that that create firewalls that delay the day of reckoning. For example, the managers of these funds, by and large, have discretion in valuing the assets. So the manager who gets paid based on the value of the assets is always going to have a conflict and always want to value the assets at a greater level. The consultants who recommend the managers are always going to have a conflict. So there's going to be all of these conflicts delay the truth coming out. And by the way, one of the things that, years ago, you may remember endowments and foundations being in alternative investments was widely touted by Yale. They used to call it the Yale model. And Yale said, we've invested, a ton of money in alternative investments. We've done great. And David Swenson, I think, said, I wouldn't recommend this for everybody, but it's worked out great for us. But the reality is that, which was not talked about, is if Yale is in investing in deals, private deals, and getting treated very well, there's probably other investors in those funds that aren't getting treated badly.
Right.
So yes, Yale profited. Yale was savvy in negotiating their investments in these private equity funds, but who lost? That's the untold story.
So the third catalyst that I could see causing some kind of crisis or run on the pension is a repeat of what we saw with the Dallas police pension. What was that, over a decade ago, where the word got out that they had some far-flung investments. I forget what it was, real estate in Africa or something. I forget what it was. But the word got out and there was a line of policemen knocking on the door to collect their pensions early because they wanted to get the money before it was all gone. And you literally had to run on a pension. I guess, since everything's so illiquid now and they can mark to METs for as long as possible, do you see any potential for that kind of scenario in the current world, or was that just such a bizarre exception?
Well, what I'm seeing more and more as I've dug deeper into the state pensions and every investigation I've done on behalf of participants has been made public. Typically a 100-page report or 100 to 125-page report, which has been made public, published in Forbes, widely distributed. And also these investigative findings have been given over the last 13 years to the SEC, the FBI, the Department of Justice, and in every case to the Attorney General of the state. We reported massive fraud, performance numbers that are mathematically impossible, fees that are mathematically impossible. And what I've discovered most recently in Ohio and Minnesota is even if you uncover massive fraud, report it to federal authorities, the feds want nothing to do with state pension matters.
Wow. State
authorities are all elected officials who depend on contributions from Wall Street. So there's really no one to report it to. Now more than ever, there's no one to report it to because the enforcement at the SEC has been gutted basically in the last few months. So I don't know. I can tell you that we have found massive fraud and wrongdoing that we have gone to everybody who could possibly address it on behalf of participants, and no one is willing to do so.
Wow. Doesn't that just make the case, I see you here, Adam, make the case for a bailout so much greater, on the part of the employees who are who are waiting for these pensions, and they could point to all your work and say, look, it wasn't like everyone wasn't alerted that there was all this fraud going on and you frittered away our money. We want, some recompense. I mean, it seems like that is clearly going to come.
Well, I think that one of the problems is that people don't understand pensions. The general public doesn't, and politicians don't, and they don't understand investing. So the outrage isn't there that should be. What I was seeing recently in North Carolina, for example, there's a legislative proposal to invest 10% of the money in crypto. And the legislators said they're going to do it in a safe way. And I'm like, what is that? So this is in the testimony. The legislator says, we're going to do it right. We're going to do it in a safe way. And this bill is actually, I think, been passed. So the legislators haven't a clue about the realities of crypto or private equity or hedge funds, but they're debating, presenting the issues to the public. They're being discussed in a way that nobody really understands what's going on.
Yeah.
All right. I'm just going to interject for a second. I've been sitting on my hands here because, Steph, you've been doing such a great job. I'm sorry to intrude, but I wanted to go kind of where you were going, Steph, on this, which is, Ted, you're saying right now, feds want nothing to do with this, right? But if some of these pensions start going under, and the state is not going to be able to bail them out, do you anticipate that there's going to be a federal bailout? Let's take CalPERS, for example. If CalPERS really started to go under, do you think the feds would still stand aside, or would there be some bailout engineered?
I think there will be bailouts. One thing I wanted to mention to you all is I worked with the PBGC on the U.S. Airways, U.S. Airlines pilots pension plan like 15 years ago. And I met with the senior executives of the PBGC. And one of the things I pointed out to them is that when pensions are spiraling down, you will see in the last 5 years, they load up on risk.
Right.
You're
throwing Hail Marys, yeah.
You know why? The Hail Mary, yeah. We're gonna,
right.
And who's selling the Hail Marys? They're advisors. They're Wall Street advisors. There's only one way out of this, and that's gambling.
More cowbell.
Yeah. So The other side of that is if you have investments that are high risk and you want to unload that risk, Wall Street, you go to public pensions. So public pensions are a lot, and I think that's what's going on right now with crypto. Is there's a desire to get government in the crypto market, and the way to do that is to sell crypto to public pensions, so that if there is a failure, there will have to be a bailout. So yeah, I think there will be bailouts, specific bailouts. I mean, look what happened recently with Tesla, where you have the president saying buy Tesla stock, and the head of the Minnesota pension saying he thinks it's great Tesla stock's going down because so you have essentially the government supporting Tesla price. But I think that's it's very likely you're going to see bailouts.
Okay. One follow-up on this, then I'll give you the baton back, Steph. So I've seen in the comments people raising this issue, right, which is, we've talked about this a little bit, Ted, but maybe we could just readdress it here, is, not everybody has a pension. In fact, it's probably more of a minority now than a majority. And if pension funds are failing, if we get to the point where they're starting to fail, doesn't have to be, but probably will be concurrent with some trouble in the financial markets and whatnot, right? And so what about the potential social clash here, where mismanaged pension going under requires a bailout, and I'm the guy who's been working in the private industry, I'm struggling right now, perhaps, because the markets aren't doing well, and yet my taxes go up because I have to bail out my neighbor who is lucky enough to have a public pension, right? How worried are you about sort of the social fallout from these bailouts?
Well, I'm very worried about it, and it's well known. It's in the industry, it's called pension envy. And for decades now, there's been a growing issue because, and this is something I've written about decades ago, is the utter failure of 401k plans. The 401k plans were never designed to be retirement plans. They were supplemental savings plans. And so you have this equally bizarre system where the average American is presumed to be an adept portfolio manager,
right,
who can decide not only what his asset allocation is, but which particular funds, and analyze the fees and the risks. And now we're seeing more than, again, getting back to the previous point, there's been a huge push under Trump 1 and now Trump 2 for private equity in private equity in 401k plans.
In 401ks, yeah.
Why is that? Because somebody wants to distribute risk. Yeah. And the untapped market is the 401k marketplace. So I think 401ks have failed utterly to provide the vast majority of Americans with retirement security. It's been a colossal failure. If you look at what is the average 401k balance for a 65-year-old,
it is scarily small, and when you look at the median, it's tiny compared to that. it's almost nothing on average. Yeah.
Let's imagine it's $100,000, which it isn't.
Which it isn't. Certainly not in the median. Yeah.
Yeah. And so, how do you retire on $100,000? And I said years ago, because employers, according to Deloitte studies, employers have known for a long time that these plans are not providing their employees with retirement security. I once sued the Walmart 401k 15 years ago. The average balance for a Walmart employee at that time, I think, was like $2,000.
Doesn't surprise me.
So employers have long known that these plans are not retirement plans, yet they've continued to tout them as such. And that is going to be a growing problem, is that people who, first of all, many workers don't have a 401k. They don't have any retirement plan at all. It's not true that all workers have a retirement plan.
Sure. Especially as folks are working multiple gig jobs, right?
The gig salary.
Yeah, and then many of the plan, and so a lot of people don't have a 401k, and then those who have a 401k, they have virtually nothing in it. And then you have these state plans that pensions that promise benefits that, because of years of mismanagement, they'll not be able to pay. So I don't know where the money comes from, but certainly it creates an environment where there's a lot of angry people.
Well, yeah, exactly. Just to my point there. So we have all that, right? And I'm the guy with nothing or very little in my 401k, and feeling very frustrated about my prospects. And I read in the paper that my neighbor's pension plan was poorly managed, right? So I'm thinking, well, they should eat their own meal there that they created. And yet, government bailout, I see my tax bill go up. And I mean, we even saw a little bit of this during the ZIRP era, right? Where it was so hard for a retiree who had saved up to get any return off of their, safe fixed income portfolio that they were hoping to retire on, right? And yet somebody on a pension was getting a check every month, and it was like they had millions of dollars that they were off, getting a return off of, right?
I remember back when one of my neighbors said to me, for the first time in history, you would make less income off $1 million savings than unemployment benefits.
Yeah.
Yeah. That was back in the, I don't know.
That's what, 5 years ago or so, yeah. So anyways, I mean, just to underscore the point, and then Steph, I'll let you go again. But I mean, what do you have any thoughts on when we get to that flashpoint, right? Where it's, hey, wait a minute, there's a subset of us that's getting a bailout here at everybody else's expense who's having a rough time. What do you think is likely to happen? Just a lot of angry thoughts, or is there some sort of unraveling, that greater unraveling that worries you?
Well, I'm trying to create that. I'm trying to draw attention to the fact I pointed out. I recently did an article about the government should create an agency called DOPE, which is Department of Pension Efficiency. Sure. And I said, and my investigations have shown that if the money was managed well over time, instead of 6.5 trillion in public pensions, there'd be 13 trillion in public pensions. And then I put a dollar amount, like in Ohio, if the pension had been managed properly, that would have produced, I think, $46,000 per house per taxpayer in Ohio, which is in excess of the average annual income of so they're very big numbers. The amount of money that we're talking about that's being lost through mismanagement could provide a lot of benefits to people.
Wow. I laughed when you said dope, but that makes a ton of sense. I actually hope they listen to you. Yeah. So sorry, Steph, take it back over here. I'm sorry.
Well, no, I mean, I was going to get to this question in terms of the bailout, which I think is the real question, because we all see that that's where we're headed. The PBGC is essentially bankrupt, right? What do they have? $100 million? They've got nothing in the PBGC, I think. Is that correct? It's something.
The PBGC, I just looked at this recently. The PBGC was bankrupt, but then they did something. I think the Biden administration did some additional monies for multi-employer plans or something. But somehow the PBGC is, let's say, less insolvent today than it was 5 years ago because of some dramatic government intervention.
But I mean, it's still nothing close to, like right now, the current public and pension underfunding, according to the Federal Reserve, which again, we've discussed is woefully understated, is $4 trillion. I mean, the PBGC they don't even have $1 trillion. I'm sure of that. I mean, they probably have a couple $100 billion or something. So that begs the question, where is this money going to come from?
Well, it was interesting. The U.S. Air pilots hired me, I think 2012, to meet with the PBGC and to do the first ever forensic investigation of a failed plan trustee by the PBGC. And we said to them, the pilots and I met with senior executives at the PBGC, and we said, we see a lot of money that's been looted from this pension by Wall Street that we could recover if you will authorize us to do so. And they said no, they were not interested in recovering money, from the the firms that had looted the money. And one of the interesting things was they said we wouldn't even know what to do with it under the statute, because if the PBGC recovered money from looting the U.S. Air pension plan, would it go to U.S. Air workers or would it go to the general coffers of the PBGC? That question has never been answered, and they didn't. So I concluded by saying to them, well, wouldn't it be better to have the money and have that problem than not have the money? And they said no, they were not interested. We proposed that every failed pension taken over by the PBGC should have a forensic investigation to determine if any parties had contributed to its demise.
Right, and prevent that from happening again. You know, you need to set the example and have there be consequences. Otherwise, like you're saying, these people all operate on the assumption that by the time the chickens come home to roost, they'll be long since retired and they won't have to deal with it. So it's, no harm, no foul.
Yeah, the prophylactic effect, we argued to them like 15 years ago, was if Wall Street knows that every plan that gets taken over by the government is going to have an investigation, that will have a tremendous effect on pension behavior, industry behavior generally. They weren't having any of it. They weren't interested.
That's just being.
But anyway, that's an answer to your question. Where could the money come from for some of these pension insolvencies? It could come from Wall Street if anybody had a desire to recoup the money that has been stolen.
That would be great, except that it's so much easier to just run the printing press. I mean, that seems to be the solution is, okay, we got to bail out. We have to fund the PBGC to bail out the pensions. So we'll just print a lot of money, shovel it into the PBGC, and they can take these things over and nothing will change. It'll just be lather, rinse, repeat. And we'll go through the Milken private equity, hamster wheel all over again. Here's a mechanical question for you, though, Ted. At what point in these state and local pensions does the underfunding, what's the threshold that requires them to start making outright contributions? Because I'm looking at state and local budgets right now that were, in massive surplus during the COVID funny money era and have, in many cases, already swung to deficit. And if they start to have issues in terms of performance, since the markets are now starting to trade a little risk off, at what level are they required, these state and local governments, to actually pull money out of, police and whatever services and make contributions to shore up those funds? Does it vary probably by state or city or?
Well, I'll give you the non-answer, which is on the federal level, the PBGC, on the federal level, there is a hierarchy where you're in the red zone, the green zone, or if you're in the green zone, you're good. And under federal law, you don't have to do anything. If you fall into the red zone, then you have to develop a rehabilitation plan to get yourself in the green zone. And falling into the red zone is if you're like less than 80% funded or something like that. So every public pension I have investigated, I note in my report, under the federal scheme, you would be in the red zone and would be required to adopt a rehabilitation plan to get yourself out of the red zone. But the answer to your question is, on the state level, there is no comprehensive regulation. So I couldn't even, you'd have to research whether for this city, this county, this state, this teacher fund, even on the state level, there are different types of, there's teacher funds, police funds, general employee funds. So the answers are not clear, not uniform.
Yeah. And presumably, again, because now they have so much, almost 40%, let's say, of their assets tied up in illiquid stuff that can be marked to whatever fantasy they want, the urgency probably isn't there. But anyway, that's a topic, I guess, that we will see play out. Do you have any observations about, I always love the hair-raising anecdotes. Are there any, this private debt, private equity, all these illiquid vehicles, are there any things out there that you've seen that aren't on the radar that I should be looking at that are potential real areas of disaster that, you know, should be in focus that people aren't paying attention to right now?
Well, I think the fee issue is very important because, as Warren Buffett would tell you, is that the fees are the only aspect of an investment you can control. You can't predict or control whether the investment's going to go up, but you can predict and control the fees you're going to pay on a recurring basis. And of course, the higher the fees, the less likely you're going to outperform or have competitive performance. But the fees are not being reported anywhere accurately. And I have never seen a pension fund that has the information to report it correctly, even if they wanted to. And in that area, I have seen, like I mentioned earlier, fund of funds. So you have a fund which is charging fees of 2 and 20.
Right.
And then a fund of funds manager who's charging fees of, let's say, 1 and 10. And then a fund of funds manager who's charging fees of 1 and 10. And then you have underlying organizational expenses and all kinds of other operational expenses that are not being disclosed. So if you add all that up, you can find some what I call toxic investments that couldn't competitively, structurally doomed. They could not produce competitive performance. And so those are the fees generally are opaque, and they're some of the worst abuses of the fund of funds. And I've seen crazy stuff like Beanie Babies, any kind of deal you can imagine shows up in these funds.
This consulting thing is another one. I mean, the fees paid to consultants. I mean, there's a whole cottage industry around keeping these state and local pension patsies invested in all the latest and greatest iterations coming out of Wall Street, it sounds like.
Yeah, there's the consulting industry. Conflicts of interest in the investment consulting industry is something I worked with the SEC on from 2003 to 2005, and because they came to me for information about that, and they tried to clean up the industry in 2005, which actually made it worse. The fix didn't work. It actually drove investment consultants into more conflicted arrangements rather than force them to shed that. So yeah, the conflicts in the consulting industry are profound. And then you have these, in the public sector, you have these conference promoters and organizations that exist to bring Wall Street and funds together. The National Council on Teacher Retirement, the National Council on Public Employee Retirement Systems. These are organizations that host conferences where Wall Street sells their products. And so there's a lot of problems in the system.
Yeah.
Can I just chime in on this real quick? So, Ted, most of those examples you're giving there are kind of abuse coming down from the top, right? From the people who are, parasiting off of all the funds at the top. How about at the bottom? We hear stories like with police forces or fire departments where, like, your last year of service, you get transferred to a different department, given a bigger title, and your salary gets boosted, and your pension is based upon a multiple of your last year's salary. So there's, all this abuse at the bottom, there's reported abuse at the bottom to overinflate the inputs that will determine what your pension's going to be. How big of an issue is that?
Well, it is an issue. I remember I heard about that first decades ago. It was called Sergeant for a Day. You would be promoted to sergeant the day before you retired so that you'd get a sergeant's pension. So there are abuses in the calculations of benefits, and there are some outrageous situations where people are getting hundreds of thousands of dollars. Former state workers are getting hundreds of thousands of dollars a year. But all of those abuses combined really don't amount to much money, actually. I mean,
so it's small
but I'm
potatoes
all for-
compared to the fee abuse. Yeah.
Yeah, I mean, Wall Street gets 20% of the profits on a $100 million investment. That's going to be a lot more money than the cop who gets, $200,000 a year. But I believe that those abuses should be called out and stopped. But if you look at the data on what does the average state employee get as a pension benefit, it's roughly comparable to Social Security. $30,000 to $50,000, somewhere $25,000 to $50,000 in that range.
Mm-hmm.
So you're not seeing particularly they're outliers, sweetheart deals, but you're not seeing widespread abuse there. We also saw in Ohio, in particular, that the state teachers' pension was hiring investment staff, huge number of investment staff. I think they had 108 investment staff that were getting paid more than any investment professionals in the local community. And that made no sense.
So sort of like the education system where they're just loading up on admin. Yeah.
Yeah. Well, the corollary is the more you have allocated to alternative investments, theoretically, the more staff you need to monitor those investments because they're not simple index funds, publicly traded. So you will see that certainly at CalPERS, that the more you get into the exotics or the private investments, the more staff you have and the more highly compensated the state investment staff is. And you will find in every state, the pension investment staff are compensated. They're the most highly compensated state employees. They make more than the governor, the attorney general. It's the state employees, the state investment staff that gets the highest paid.
That's a sweet deal. All right. So, Steph, I'll let you have about 5 more minutes with Ted because we've got to start wrapping up, and then I'll come on and I'll put a bow on it.
Actually, I was going to ask him, I was going to tee him up for the last question, which I think is the perfect opportunity for you to advertise your services. Ted, that was going to be, how do you recommend that people who have pensions that they're worried about that are exposed to all of these illiquid assets and that are underfunded chronically and are going to run out of money, how do you recommend they address that? Is there any action they can take to kind of protect themselves?
Well, I will mention the book again that Robert and I wrote, because this book gives a very basic understanding of the fundamental truths about pensions, public pensions. Every state worker should have a copy of this because it says that there's certain universal truths. They all overstate their performance. They all understate the fees they pay. They all understate the risks they take. They're all lacking federal regulations. You just need to understand these basic truths about all public pensions before you start diving into your own. And what I started doing back in 2012 was offering state workers, participants in public pensions, the opportunity to crowdfund a forensic investigation. This was at the same time that the equity crowdfunding was being considered by the SEC. So it was in the news. And I thought, well, what if we allowed participants in a pension to contribute, say, $25 to have an expert of their own choosing look at their pension? Would it be something that they would want to do? And it has been done successfully now. So that's something they can consider is, first of all, I'd say read the book and get an understanding of the flaws in the system, and then consider having a forensic investigation done through the crowdfunding.
Yeah, well, I guess that, and then also prepare for the possibility that whatever pension you're being promised might not actually be there. Probably take measures to save on your own outside of that, just in case things don't work out.
Yeah, the problem with that is the same, like, with Social Security, is that most people really who, a great deal of elderly Americans rely almost exclusively on Social Security. So to say to them, prepare for the potential demise of Social Security, it's like, well, how would I do that? And I personally don't think, if Social Security fails, America is over. It's done. I mean, there will be, the country would fall apart, and the majority of elderly people would be homeless, and it would be the end of the world, basically. Yeah. But for these, it's not very helpful to say to them, to state workers, prepare for the possibility that your pension may not be there. And in some states, state workers do get Social Security. In many states, they don't. School teachers don't. So it's if they get a state pension, they don't get Social Security. So that's been an issue for a long time. But what I would say is, my observation with pensions is that because this is a long process, like Social Security, the fixes usually are incremental changes. So it's the younger teachers who are going to get screwed. Right. The older teachers are getting a better deal, and it'll be kind of more like death by 1,000 paper cuts over a 30-year period rather than a sudden collapse. The closest thing to the sudden collapse I think you see is Kentucky. Their pension is in terrible condition. Last I heard, it was 12% funded. Wow. So there are some states and cities that are in terrible shape. There will have to be some kind of bailout, but it can be sort of a pay-as-you-go type of bailout as well.
Yeah. Wow.
All right. Well, look, I'm gonna rest back the baton here, but folks watching, please, first off, give Steph true props in the live chat here for what a great interview she conducted. This is really fun, Stephany. We need to keep this modality going.
I mean, I could talk about this stuff all day, but I don't want your audience to throw themselves out the window.
No, well, and look, folks, if you want us to bring Ted back on to keep talking about this again in the future, maybe give us an update later on in the year, please let us know. I'm sure folks are going to want that. I've got the unenviable job of bringing this really interesting discussion to a close. I got a couple things to mention as we really wrap up, but one last general question for you, Ted, and I'll take your short answer on this. We can dive into it later in more depth. But let's say, the new administration is listening to this video and they think, dope sounds wonderful. So they create it. Ted, they put you at the head of it. They give you, Elon Musk style, access, and also just people have to do what you say. Are there one or two reforms that, you would most want to implement right out of the gate in terms of addressing this problem?
Yeah, when I proposed DOPE, the Department of Pension Efficiency, a few months ago, I said, this is the easiest problem to fix in America. It would result in no loss of jobs, really. This is the simplest way to save $6.5 trillion. And the fix is very simple. A, all public money has to be transparent. By doing so, you've eliminated all private investments because they're not transparent. They refuse to be transparent. So, and then the simplest fix is to simply index the $6.5 trillion, and that would result in improved performance across the board. But even if you don't go to 100% indexing, go 100% transparent, and that alone would be a complete game changer. And by the way, that was the intention of our state public records laws for the last, 50 years, 70 years, before the last 20, when that's been, eviscerated. But it's a very simple problem to fix, and the results would be tens of thousands of dollars in savings. Forget the $5,000 Doge check. we could give every American a $50,000 dope check.
Wow.
All right. Well, look, I'm seeing lots of comments there in the
great.
live chat. Ted for dope. So there's a lot of folks there hoping for that. Well, Ted, look, one, thank you so much for coming on and doing this with us. Super fascinating. It's sad there are so few people ringing the alarms about this, but we so appreciate that you are one of the few who are dedicating your career to doing this. For folks that are watching who would either just like to learn, follow you or learn more about your work, but probably even more importantly to Steph's question, if they're like, look, I've got a state pension I depend on, and I might want to do some crowdsourcing to see if we can't find an independent audit of it, how can people reach out to you?
Well, I write a Substack, which is Pension Warriors by Edward Siedle. And then, like I said, you try to read the book. I think it would be helpful to to learn more about it. But I'm the easiest guy in the world to find. My phone number, everything's all on the internet. And so just reach out to me, and I'd be happy to. I always answer my phone. Be happy to talk to them about it.
All right, great, thank you. And folks, I just put the link to his Substack there in the live chat. And real quickly as we wrap up here, first off, if you folks haven't already done so, Stephany, our fantastic interviewer for today, she operates at macromavens.com. And Steph, real quick, if you can just give a quick summary again of the retail offering you make available there.
Oh, yeah. So that's information available on the website. It's once a month. You get to listen to me rant about all the things that are controversial out there. So you can sign up there and also follow me on Twitter at @Pomboy, or right here every other Wednesday with Adam.
Yeah, every other Wednesday here at Thoughtful Money. And very quick, and just wrapping up, I'm putting up the URL here to thoughtfulmoney.com because retirement is a universal, I think, for everybody watching this. A universal concern, meaning, okay, am I going to be able to get there? Is my money going to last for me? Obviously, if you are dependent on a pension and are quite worried about this discussion, then I highly recommend that you talk with a good financial advisor about steps you might be able to take now to try to make sure that you're getting your cost footprint under control, so that if indeed your pension turns out to disappoint you, you've got at least some cushioning against it, and maybe some other things that you might be able to do to increase your retirement nest egg there. And obviously, if you don't have a pension and can't depend on a bailout, if you don't have great confidence in your ability to retire by the time you want to retire with the money you want to retire at that time, again, very helpful to talk with a good financial advisor to put together a financial plan to try to increase your odds of hitting that. And if you don't have a good one who can do that for you right now, feel free to talk to one of the financial advisors that Thoughtful Money endorses. They'll sit down with you for free and discuss all this personal to your situation. To do that, just fill out the short form there at thoughtfulmoney.com. All right. I can't thank you both enough, Stephany and Ted. Ted, it's great to see you again. I think it's been about a year since we last talked. It is a bit sad that the situation hasn't improved at all since then, but of course, that's what you've been warning about anyways. But can't thank you enough. And folks, if you enjoyed this, sort of special report on a specific topic of concern like this, would like to see Stephany and I do more of this, please let us know in the comment section below and in the live chat. And if folks want us to, we definitely will. But Ted, look, I'll let you have the last word here.
Well, I just wanted to say that I heard from reporters in Ohio about the work you and Steph have been doing, the broadcast you've been doing recently, and they were thrilled. They said, well, that's great. You're going to be on the show with them, because evidently whatever you're doing is sparking a lot of interest in the Buckeye State.
Well, thanks. That's an honor to hear, and I can guarantee you that's about 98% Stephany, and
not at all.
Of that equation.
But I just want to say I've so enjoyed getting to meet you, Ted. I've seen your interviews with Adam, and this was really fun. Thank you for your patience with me and my silly questions, but I really enjoyed the conversation, and hope we all three of us get to reconvene, hopefully under more positive circumstances, but somehow I'm doubting that.
Well, great. Thanks for inviting me.
Thanks for coming on, Ted, and everybody else. Thanks so much for watching.